Gold is moving higher, even hitting a new one-year high this month. Concerns about the economy, inflation, and the declining U.S. dollar are likely fueling the rise. General anxiety about the stability of the banking industry could also be a factor, with Silicon Valley Bank suffering the most significant U.S. bank collapse since 2008. Is it time to get on board? Is it time for gold to shine? Traditional investors look to gold as a hedge against bad times and against rising inflation. However, gold hasn't always delivered on these promises. For example, from early March through late October of 2008, the stock market declined 24%, and gold fell 28%. Clearly, there was no hedging there. Gold also wasn't much of a hedge last year when it declined 15% from April to October, while both stocks and bonds were down. Looking at inflation, the Consumer Price Index rose 6.5% last year, but gold remained flat. So gold certainly wasn't a hedge when inflation flared up for the first time in many decades. All of that being said, gold has been a safe harbor in some storms. That was true during the Great Depression, and again during the hot inflation of the 1970s and 1980s. But unfortunately, it just hasn't been reliable. The bigger issue is that gold has been quite volatile. Even during its impressive run in the 1970s, gold lost 44% between December 1974 and September 1976. It then went on to even greater heights, but it was a wild ride. And that's not unusual. Gold fell 43% from its peak in September 2011 to its low in November 2015. And there are many such other examples throughout history. So gold may have a place as a short-term trade, particularly if the US dollar continues to weaken, or maybe it makes sense to hold a small amount of physical gold as a hedge against economic collapse. But it probably isn't the best addition to a long-term investment portfolio if you're seeking inflation protection and diversification.